there's some room for this market to get some legs underneath it. But, we've got some work to do. First of all, we've had basically, 8 straight months in a row where markets have been positive. That's a very long stretch. So, having a month or two where you get some consolidation or a bit of a contraction even would not be surprising at all. Say the last half of this month, we have a 3 to 5% correction for, whatever reason. That would be totally unsurprising given this massive run we had from those April lows. You should expect probably this year in 2026 at least two 5% corrections and probably a 10% sometime this summer would not be surprising at all.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap with my good friend, the done and dusted portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing good. Very excited. Next week, of course, when we're having this conversation on air, you and I will actually be in Houston for our investment conference. So we've got 1 week left. We've got a few tickets left available on the website. So if you go to realinvestmentadvice.com, click on the link at the top of the page and get your ticket. Love to see you here. We've got time to visit. Adam and I both will have plenty of time to visit, hang out, talk after the conference. So if you haven't got your ticket yet, be sure and do it. It'll be a really good conference.
Yeah, should be really fun. Looking forward to doing this market recap with you live next week in front of your live audience. So folks, if you're watching and able to get to Houston next week, please join us. It's going to be a great time. So Lance, I chose done and dusted because your wife's chemo treatments are now behind her, correct?
Exactly. Yes. Very excited. All the blood work has come back exceptionally good. So her CA 125 is down below 10. Now it's at 9, which is one of the tests. Normal ranges are up to from like 0 to 30. So she's well into normal ranges, which is fantastic. I told you about the singularity test, which showed no evidence of disease. So she's done really good. She's just recovering now. The last chemo was Friday, so she's just now starting to get past the nausea of that. But she's very excited. She's starting to grow back hair, so she's very excited about that.
All right. Well, look, we are super excited for her and for you that the news appears to be developing so nicely. I know you're not out of the woods for
Oh no.
years until, they clear you, but how fantastic that things have been going the direction they have been in. So wonderful. And I really look forward to giving her thanks from everybody from Thoughtful Money in person at the conference next week.
She'll be there Friday night for sure for the mixer. So she's looking forward to seeing you.
All right, fantastic. Well, and Ashley, my wife, is coming too, so she's looking forward to meeting her in person as well. All right. Well, look, lots to get through and not a lot of time.
Yep.
Lance has got to get out of here for another checkup with the doctors there. So we'll get you out on time here, Lance. A lot to cram in here. Hopefully, a rant that might not even be a short one. So we'll see if we can't get it all in, and if not, we'll make changes on the fly. First off, folks, forgive me if I look a little peaked. I got in real late last night. Investing in one of the most important things, which is your social capital, your community. As folks know, I moved to Reno this year and got invited to my first guys poker night last night and didn't crawl back into the house until quite late. So I'm recovering from that. What I did learn most from this, Lance, besides that there are some really great guys I hadn't yet met that I got a chance to spend time with last night. But as you learn during events like this, the power of alcohol and luck is just amazing. As folks know, I don't drink, so I have no excuse for performing poorly in things like poker. But the guy that just cleaned the table, Lance, just got drunker and drunker through the night. And he started amassing so many chips he could kind of push people around. But he got to the point pretty early on where he wasn't even checking his cards. Playing Texas Hold'em, so you get dealt two cards right at the beginning. His big thing became like, I'm just going to bet and I'm not even going to look at my cards. And this bastard just kept winning again and again and again. I kept waiting for reversion of the mean to kick in, for the alcohol to really kick in. And this guy just cleaned the table until his wife came and took him. And then we divvied up all his chips because he had all the chips at that point in time. So anyways, It's always a caution of, if you're sitting at the table and you're feeling like the patsy, you probably are. And I definitely was last night. All right, so lots to get through here, Lance. Let's start with the markets. Everybody is feeling the tractor pull to the big round number of 7,000 S&P, but we haven't quite hit it yet. And last time you were on, we talked about that you were seeing some healthy rotation, some broadening of the markets. Is that what's continuing here? Is that sort of what's keeping the Mag 10 from pulling the S&P to 7,000 because capital is starting to flow in some of these other sectors that have been less loved?
Well, it's actually the Mag 7 that's keeping the index from getting to 7,000 because they've actually kind of been underperforming. Apple, Nvidia, Google, Meta, they're doing okay. There's nothing going wrong with them, but they're just really not going anywhere.
Right.
So
That's what I'm saying, because the capital, I think, is flowing into other
yeah,
parts, right?
yeah, right, right. So yeah, what's been supporting the market here is we're definitely saw, in fact, I'm writing about that in this weekend's newsletter. Um, which is part of the discussion is looking at value versus growth. And value has been outperforming growth now for the last few weeks. And in fact, just last week on the first trading day of January, we launched a new factor rotation model on SimpleVisor. It's an actual live dollar portfolio. So I've actually got capital invested in this portfolio. But it looks to rotate between value and growth. And right now it's about 80% value versus 20% growth.
Really?
Yeah.
Okay. So this is new, but you think this is apparently going to be an important enough theme of 2026 that you've committed real capital to this?
Well, no, we've been so Nick Lane, who is our one of our CFAs on our investment team, has been researching this model for about a year and a half now. We've been back testing it in a whole variety of different manners. No, this is a long-term portfolio. It's not something we're designing just for 2026. There is a long history of value versus growth rotations, and in fact, if you put a value chart up against a growth chart, they're almost mirror images. And there are times when growth outperforms, there's times when value outperforms. And so, what this model looks for is it looks for relative changes to that correlation between value and growth. And then it rotates the portfolio between 80% growth or 80% value based on those changes. So,
When you
it's
say rotates between
Mhm.
80%, is that in gradations along the way, or is it just 80 one way or 80 the other way?
No, it's in gradations. As we
Okay.
start to see the relative performance pick up, we start migrating over. It can happen very quickly, mind you. So this portfolio isn't for tax sensitive people because it can have a lot of turnover within a given year. But over time, the value versus growth relationship works out well and provides better performance with a lower beta volatility than you get just in owning an S&P index.
Okay. Um, how what are your expectations for how active it's going to be going forward? And I only ask that because it seems, and I could be wrong here, but it seems like for the past bunch of years, it's kind of been pinned to growth. That value's really gotten the short end of the stick for quite a long time.
And that's right. I mean, you could be in the growth side of the equation for a year or a year and a half or two, and then it rotates into value for 6 months, 8 months, a year and a half. Then it rotates back to value. So it's not this isn't something that rotates like every week. It takes time for these changes to occur, and so we're looking for the macro changes of value versus growth. But there's enough historical work there and evidence that's there that gives us a pretty good model to work off of.
Okay. All right. Well, so maybe we should just pull up the S&P and get the technicals out of the way, especially since we're pressed on time here. Um, but what do you think now? Okay, we're in a new year. We're not that far from 7,000. The momentum here is up and to the right. Not quite as strong as it was, for what, July through September of last year.
Right.
But it's still, it still doesn't look like we've reached any sort of technical peak in the market yet, but correct me if my assumption's wrong.
No, it's right. I mean, take a look at the chart of the S&P. We're bumping up. It's interesting. We've set some new all-time highs this year, but we haven't actually closed above intraday highs. So, we're kind of bumping up to the top of this kind of trading range. And again, we're looking back here, you've got a kind of a nice flat top to the markets, but it's creeping up. So you're kind of creating this kind of rising wedge that's bullish. So a breakout above 7,000, you should get a little bit of relative momentum behind the market. So, we're not overbought. You look at relative strength, it's improving, but it's not overbought. Momentum signals are, kind of in a good average range. They're not overbought either. So there's some room for this market to get some legs underneath it. But, we've got some work to do. First of all, we've had basically, 8 straight months in a row where markets have been positive. That's a very long stretch. So, having a month or two where you get some consolidation or a bit of a contraction even would not be surprising at all. Say the last half of this month, we have a 3 to 5% correction for, whatever reason. That would be totally unsurprising given this massive run we had from those April lows. You should expect probably this year in 2026 at least 2 5% corrections and probably a 10% sometime this summer would not be surprising at all. But given those opportunities, those will be some good spots to add to exposure, increase your equity, kind of risk profile, so to speak. Markets should kind of try to push their way higher, at least here over the next few months, because again, momentum's in place, earnings still look good, economic growth is okay, nothing going wrong there. We can talk about the employment data. It was weak. That's certainly a concern. But what markets are focusing on is that weak employment data means the Fed's going to remain easy, and that's going to provide more monetary accommodation. Buybacks are going to be about 1.2 trillion this year. That'll be another strong support for markets. So there's not a lot of catalyst right now for a big major reversion, but that doesn't mean we're not going to have some corrections along the way.
Okay. So let me ask you this. So let's talk about the jobs for a second. We got the ADP and the payrolls this week for December. Both were sort of slightly less than expected, but not a ton, right?
Right.
So definitely, not warning bells or anything like that. And on the unemployment rate, it actually dropped a tenth of a percent to 4.4%. So to your point, Lance, it's kind of almost like a Goldilocks result for the way that Wall Street likes to look at things, right? It's not bad, so we'll feel good about that. But it's bad enough, it's weak enough that the Fed is likely to continue its easing, right? Which of course is what Wall Street wants, right?
Well, I mean, if you take a look at full-time employment versus the working age population, that's declining pretty sharply. And that certainly doesn't suggest that you've got a roaring economic backdrop, right? By any stretch of the imagination.
Well,
Printing out 50, go ahead.
true, but let me just mention this so you can include it in the rest of your answer. GDP has for GDPNow has been sharply revised up, and I know there's some reasons for that, but GDP growth is not coming down, and in fact, there looks like there could be catalysts to the upside. Some of the things we're seeing in the GDPNow data, and then you and I talked last week about at least the administration saying, look, there's a lot of things that are coming, and we're going to talk about some of that stuff today. So, could we actually have a strengthening economy that's not paired with job growth,
Yeah.
right? Whether
Yeah,
AI or whatever just keeps things muted, not bad, not mass total firings like we've seen in past recessions, but just hey, this economy is beginning to warm up, but that doesn't necessarily mean that the employers are going to start hiring, in robustly anytime soon.
Right. Okay, but it's all fine. That's right. The GDPNow number was revised sharply up because you had a massive surge in net exports because of gold exports alone, right? So you had this massive surge, a historical surge in gold being exported out of the U.S. So that gave a massive bump to the trade, the net export issue in GDP, which gave it that massive jump. That's why it doubled. That's not a sign of economic prosperity at all, right? That's a one-off anomaly. We saw that same anomaly back earlier this year. We saw a big drop in GDP because of front-running tariffs, and that was a big trade deficit issue. And we saw the net export number really be the big contributor to that drop in the first quarter, and then it came roaring back in the second quarter because that was all reverse after tariffs. So you're seeing the same exact impact now. But
Sorry,
what
but if you back out that gold bump, I think the GDP growth is still solid, right? It's not like it's
no, no,
weak
it's still
without it, right?
solid. It's about 3%, right? On a quarterly. Now you got to remember how GDP also and now GDP now is also reported. They're taking their number and multiplying it by four, right?
Right.
So they're taking the quarterly number. So say it's 3%. You have to take that number and divide it by four because that's what the quarterly GDP actually is. So again, it's just assuming that when you read that number, GDP 3% or 5%, whatever, it's assuming that every single quarter going forward is going to be exactly the same as this quarter, which is not really a great way to look at data because data doesn't work. But it's it makes for great headlines. But the bigger point that you're missing is that you don't want economic growth without employment because that
I'm
means
not
you don't.
missing. I know. I agree with you there. I'm just saying that might happen this year, right?
Well, yeah, it might happen, but that doesn't increase earnings, right? And so at the end of the day, what we want is we want earnings to grow for corporations. That comes from economic activity. And if I'm not putting people to work, then I don't have as much money spent in the economy. Yes, I'm going to have some one-offs this year that's going to keep economic growth supported. You got a lot of AI spending on capex, a lot of business investment, those type of things. But that's not going to lead to broader economic prosperity if we don't have job growth to go along with it. And what we need more importantly than just job growth is we need full-time employment that pays benefits and allows people to support families and those type of things. So yeah, we can have economic growth that looks good on the surface, but underneath you get a deterioration in economic prosperity that eventually flows into corporate earnings.
Okay. So, I mean, I agree with all that. And look, I'm hoping both for a stronger economy that comes with greater real wage growth, right? Um, it's interesting. What I'm trying to do though is just prepare people for some of the
Yeah.
possibilities of this year. And you and I talked last time about how we could have a year of strong economic growth, but poorly performing markets, right? They don't have to be correlated. And obviously, when valuations are as high as they are right now, the risk of that happening is higher than normal, right? We have this K-shaped economy as well. And, as long as asset prices don't crater, those who have assets are going to continue to spend. And we just got the holiday spending numbers. We saw that online holiday sales, but I think this is true of all, hit a new record, 258 billion, basically, heavily driven by buy now, pay later, and people responding to discounts. So, not necessarily the healthiest sign there, but to your point about the importance of earnings and whatnot, the spending is still there. And that could continue through the year, driven by that top cohort, right? Again, on average looks great, on median wise doesn't, but GDP only really cares about the average until and unless the bottom 80% really get into tough times.
Well, and again, we talked about this earlier this week on the show, which was that, one of the things that you never do is count the consumer out. And it's like, oh my gosh, consumers have so much debt. They're about to tap out, and this market's going to crash. The I've been in this market for over 35 years, approaching 40. And I tell you, over the years, what's always amazed me is how consumers can find more money. Whether they find it on credit cards, they take out loans, they go sell, their kidneys, whatever it is. Buy now, pay later is, the new thing. But it's always amazing to me is that consumers are always able to find more money to keep spending. And again, it's funny. You and I talk about the K-shaped economy and how things aren't fair. And people can't afford houses or whatever. And a massive function of that is their own financial, kind of habits and what keeps them poor. And what keeps them poor is finding all these alternative measures
Right.
to spend money.
Right. When
And
they should be tightening the belt and really, yeah.
yeah, but again, it's the the one, and again, this old axiom of Wall Street's never count the consumer out because they'll always surprise you.
Yeah, no, I totally agree. And I feel like going into credit card debt is like the analogy there is selling your kidney. I think going buy now, pay later, the analogy is like selling your second kidney.
Exactly, it's selling your heart, just
Yeah, it's like eventually, once that's gone, it's gone. Yeah, exactly. By the way, folks, we're kind of laughing through the tears on this one.
yeah.
Um, So let me stick on this just for a second here. So from my perspective, you disagree with me if you're seeing something different. There are a few signs at this point that we're heading off any sort of economic cliff. And look, I'm the first guy to say, to give you the long list of reasons why we could end up falling off one. But to your point, Lance, we have to trade the world as it is, not as the world as we think it should be or wish it were, right? So, so first off, I think we just all have to acknowledge that, right? And so if you're pessimistic about the current economic system and the current markets or whatever, you just want to be eyes wide open, right? So you don't necessarily want to be taking a drastic position. In your case, Lance, that might just be going all into the bunker type of investments, or even more aggressively going short. A guy I know was pinging me yesterday, telling me that he's gone pretty short for March and April. And I'm just basically telling him, man, I hope that works out well for you. But that would make me nervous on that too short of a timeline here. So we're not seeing a ton of signs yet of the wheels coming off, and there are factors, as you and I have discussed, that could make the economy surprise to the upside this year, right? And certainly, if you're listening to the administration, Secretary Bessent, whatever, he'll give you a very thought-through litany of reasons why he thinks the economy is going to be running much hotter at the end of this year than at the beginning. And a lot of this stuff is, he would say, these are the investments that we made through 2025 with all the new policies we passed and all that type of stuff. And I think you count that stuff out at your danger, at your risk, right? I'm not saying they're going to manifest, but I can see how if they do, they'll have the impact that the administration thinks they will. So you've got to have some positioning in your portfolio. Okay, if the administration actually succeeds on that, I got to make sure I'm not steamrolled by that. Now, in addition to what I think they've been trying to do, which is to create things that are going to drive more secular growth, it is increasingly clear, to me at least, that they are willing to do whatever it takes in the near term to try to support the system, goose the system in advance of the midterms, right? So, we're going to get the biggest tax refunds apparently in history this year. That's going to be hitting pretty soon. A lot of that money is going to be spent. It's going to juice the economy. Presumably, and we're still waiting to hear what the Supreme Court's going to say about tariffs, but there's a bunch of tariff revenue that's come in that the president has said, hey, I'm gonna send checks to middle income households with that. If that indeed happens, that's going to have a stimulus effect. We just saw yesterday the president announce that somehow he's going to find somebody to buy 200 billion worth of mortgage-backed securities here, right? So to me, Lance, to me that says, look, the administration's getting really serious about kind of buying votes, for November. And whether I like that, whether I dislike it, and folks, I dislike things that are artificially stimulative. I got to admit that if they do this stuff, it may actually juice both the economy and the markets. So, I got to be eyes wide open to the fact that, yeah, even though I've got some of these concerns, these things, at least in the short term, could overpower them. What do you think?
Oh yeah, no, absolutely. I mean, you just take a look at the deregulation. You've got a lot of benefits coming from the one big beautiful bill that'll factor through this year. Tax cuts are one of those. There's a lot of economic support, for the markets, both economically and just fundamentally in the markets for this year. Doesn't mean that things are going to work out fantastic. There's a lot of other things that could come along that could certainly undermine that. But as a good example, let's say the Supreme Court was, so as you and I are talking, it's about 10:30 Central Time here in Texas on Friday.
On Friday.
Friday. The Supreme Court was supposed to rule on tariffs at 10 o'clock this morning. They didn't. They ruled on another issue revolving around prisoners being able to have their sentences reviewed by the Supreme Court. But we didn't get a ruling on tariffs. So that still might come. But see, even if the Supreme Court comes out and rules against tariffs, which is, according to poly markets anyway, that's a pretty high probability they will rule against the tariffs, then, the question that becomes is, what does the administration do next? Well, Scott Bessent's already said he's got 3 or 4 other avenues to go down to get tariffs, kind of reinstated using some other means. We'll see what happens. But if you repeal the tariffs, it's actually good for companies like Staples and a lot of value companies, manufacturers, et cetera, that do imports and exports on an international basis. That's going to help improve their profit margins because you just removed the tax. So that's going to be good for the markets. We all debate over the validity of tariffs and whether they're good or bad or indifferent. But just the bottom line is, if you take tariffs off companies, that's going to be a boost to bottom line profitability. So so again, there's a lot of things that are supportive of the markets right now, but that doesn't mean that in 3 months or 6 months something can't crop up that kind of pulls the rug out of underneath the markets. And again, that is the thing. Mind you, all this stuff that you and I are talking about, the market's already factored in, right? There's nothing you're thinking about or I'm thinking about that the market hasn't already thought about. That's the beautiful thing about markets. It's millions and millions of minds all trying to figure out what's going to happen next. So all that's factored in. But the thing that gets the market is something totally unexpected, like, the president standing in the Rose Garden going, hey, look, here's the tariffs on a board. And the markets weren't expecting that at all. So you got a big correction. It'll be some event that causes Wall Street to go, you know what? We're not going to make $330 a year in earnings this year. It's going to be 300. What does that mean for valuations? And that's where you get a price correction in the markets.
Yeah. Well, so what's interesting is I feel like this, so last week when we talked, you basically said that you were going to write kind of a redo or a second version of the piece you wrote at the beginning of last year, right? The Curb Your Enthusiasm thing.
Yeah.
I can't remember, you were going to use a different analogy or a different TV show this year.
It's South Park this year.
South Park, okay. But basically making the same case, right?
Mm-hmm.
Which is that you think this year is probably going to be more volatile and probably it's going to be a tougher year than say 2023, 2024, right? And even most of 2025, how 2025 played out, right? And similarly to that, or corroboratively of that, I'm finding that the people I interview on this channel, like the really smart people who are really plugged in, they're coming up with very different perspectives on next year. So two people in particular who I definitely place a lot of weight on their analysis. One is Jan van Eck. So, he's the president of Von Eck family of funds, right? I mean, they've got ETFs in virtually any asset class that you can think of, right? And Jan kind of sits at the center of the web there where all that information flow is coming through his desk. So he's got one of the probably most informed perspectives on the securities market than anybody that I know. And Lance, he is really bullish. He just did a presentation that's going to release on his channel the day after this video airs, so that'll be Sunday for folks. And he walks through a bunch of charts and basically gives a pretty compelling reason for why he thinks 2026 is going to be a big risk-on year. And I did the whole thing with him about just statistically, 4 years in a row of great returns is rare and stuff, and he gets it. But he's like, I'm just telling you, looking at all these factors here, they make me pretty darn bullish for the year, right? So very compelling case. Now, a video I just released yesterday was with Michael Howell, who's Mr. Liquidity. And Michael was one of the very first. I think he was the first guy that I knew who really stuck his neck out in October of 2022 and said, guys, it's time to go bullish. And it's largely based upon his framework of global liquidity, and it had bottomed and it had started going back up, and his liquidity cycles run in several year timeframes. And he basically said, the cycle is turned, I think we should be bullish. And he remained bullish all the way up until just now. And he's saying, my data is telling me that the liquidity cycle highly likely peaked in Q4 last year, and we're going to be riding it down for the next couple of years, unless there's a correction that's so severe that it just shortens the cycle. So he's basically saying, look, I'm not necessarily calling for like a crash in 2026. I'm just telling investors it's going to be a disappointing year compared to the previous 3 great ones that we've had. So my point here is just, it's going to be tough to really predict this year well. And so it's the kind of year where you're really going to have diversification or multiple strategies in place to be able to say, okay, look, if my primary thesis is wrong, I want to make sure that I'm not wrecked because of that. And it's a year where I just think the chances for surprises are higher than normal for all the reasons that you just mentioned and I just mentioned.
Yeah, no, and that's why, I think predictions are pretty foolhardy. And we don't make predictions for the year. We just produced our outlook for 2026, which is a range of outcomes that ranges from 5,500 to 8,000. And the whole point of that is that the markets can wind up anywhere in between that range, depending on what comes. And so what's important is just to navigate the markets. It's interesting if you think about how most people invest. They go, "Oh, I think the market's gonna be bullish this year, so I'm all in, growth stocks or whatever." And then things go wrong and they lose a bunch of money.
Right. Or
And
they just have even just the rotation you're talking about, where they
or
go
even
nowhere because the investors went everywhere elsewhere.
exactly, or vice versa, right? They go incredibly short, the market keeps running higher, and they wind up on the wrong side. So for us, it's simply like navigating a ship. Is that I'm not just going to get my ship and say, okay, I want to wind up in Alaska and just point the boat in that general direction and hope I get there. You're going to navigate. You've got storms to worry about. You've got obstacles to worry about. You've got a port for fuel, whatever. So
Sandbars, pirates, weather. Yeah.
exactly, always pirates. They're always a problem. So but yeah, I mean, the goal is that we just have to navigate that ship to our end goal. And as things change, we're going to change our place in the markets. Look, we're overweight equities right now going into the year because we're still bullish on the year. We're still long our Googles and our Metas and our Nvidias. We own those guys. But we've recently added things that are really stupidly boring, like, Altria, which is boring. It just throws off an 8% yield. It's just those type of things, added a bit of Verizon to the portfolio. It's really boring. It doesn't do anything. It just sits there and throws off yield. That's okay, because if the market does correct, money's going to rotate into those sectors, and that provides us some ballast in the portfolio that we can increase later on if we need to. So yeah, we got a little bit, we're kind of tapping the brake just a smidge, but it's not enough really to slow down the momentum of the car right now.
All right. And sorry, by tapping the brakes, again, you're not diminishing your equity exposure. You're just shifting a bit more of it to these boring, more defensive plays.
Yeah, and very small. I mean, we're still probably 85% growth versus value right now in our primary models. Like I said, depending on the model that you're talking about, but in our primary model, we're still about 80% growth in allocation, about 20% value and defensive, and that'll shift, as kind of markets dictate. But right now, there's nothing telling us that growth is falling off a cliff right now, and so we want to stay more exposed to that long side.
Yeah. Okay. So how to transition into this? I guess let me ask you this. Do you have an opinion on international stocks? So right now, India is the fastest growing country in the G20. It's a market that Jan van Eck has been really bullish on for a couple of years. Valuations got pretty rich. So, middle of last year, he was like, I love it still, but I'm not sure if I'm a buyer at these prices. Things have cooled off a little bit. Not necessarily asking you about India, but the rest of the world stocks actually outperformed the S&P last year. Um, do you have a sense as to whether you think that's going to continue this year, given all that growth?
There, so if you take a look, okay, so first of all, you got to break down the world into regions. So you can't just say international versus domestic, because, for instance, the Eurozone is not going to grow at all. They're, way behind the curve on terms of AI and what's going to happen in that growth cycle of AI. Their GDP, they're plagued with years and years, decades of bad monetary and economic policy that have just kind of really destroyed the growth cycle of those countries. And so the Eurozone, quote unquote, will grow around 1% next year, according to the IMF. US GDP growth is going to be closer to 2. You start getting to some of these emerging market countries like India, China, et cetera, their growth rates are going to be a lot higher. But you always have to remember one thing about international. This is the big factor that comes back into all of this. The miss, I should say, the misstatement that's always made is that, well, these countries are cheap relative to the U.S. That's a bad analogy. For 15 years, international markets have vastly underperformed U.S. markets. So again, if you've owned a bunch of international emerging market stocks, yeah, they weren't great last year, but over the last 15 years, just as an example, they just so massively underperformed. They were like a major boat anchor to your boat getting to where you want to go. So it just really dragged on your overall performance. A lot of these countries, and again, as your guest said, India is very rich right now relative to itself. So when you're thinking about investing internationally, I'm certainly not opposed to it at all. I think you have to look at each country that you want to invest in and determine, is it cheap relative to the country itself, not relative to the US. It's irrelevant. It's only, is it cheap or expensive relative to itself. And if you can find a country that's trading very cheaply and they've got good, strong economic prospects, that's probably a good place to put some capital. Unfortunately, I just don't see a lot of those areas in the world right now.
Okay, so obviously, folks, watch the video with Jan to get a little bit more specific on some of the other parts of the world that are catching his attention. But for a second, I know you said you're not thinking of it this way, but just think of it as the rest of the world, right?
Yeah,
And I'm sure there are funds where you can just buy, a mix of
everything.
everything.
Yeah.
Given, again, this is the difference between economic growth and stock market prices. So US outgrowing a lot of other places like the Eurozone. But stocks very richly valued, right?
Mhm.
So with a broad brush, you know, international stocks outperformed the US last year. Do you think that momentum is likely to continue or not this year? Or maybe as a more simple question, what role should they play in a portfolio? Just non-US exposure.
I think you're late to that trade. Momentum will probably carry that international trade maybe a few more months, maybe even the rest of this year. It's very possible. One of my favorite charts to always look at, as I'm sure you've seen it, Adam, is the Callan periodic table of returns.
Yeah.
And so it shows you on these periodic tables, it's like a periodic table of elements, right? But it just shows you, what asset class performed the best last year all the way down to the worst. And what you'll notice in particular is that, first of all, anything that's at the top of the return structure for 1 or 2 years always winds up at the bottom of the return structure in the subsequent years. So that just always, this is why investors always tend to be wrong, as they chase what was performing at the time it begins to underperform. But
Usually,
internationally,
I would agree with you. I mean, for too many years recently, the hyperscalers have been up near the top, but yeah,
yeah.
generally
But
you're right.
again, S&P is, again, 2 or 3 years at the top, and then it'll fall, like we had in 2022, right? You had a correction in
Yep.
2022. But the point is that international markets in particular spend less time at the top than they do at the bottom. So, just they outperformed really well last year. Could they do 2 years? Yes, that's not entirely impossible. But I think you're getting, given the economic growth dynamics of those countries, I think you're getting towards the tail end of that run, not the beginning. So just,
Okay.
the point is, if you're going to own them, it's fine to own them. Just make sure you understand your risk profile and how you're building it into your portfolio structure.
Okay. So you said that you are starting to increase slightly right now, but maybe more as the year goes on, TBD, your portfolio into sort of more defensive areas, right? The more boring, less sexy, high income stuff. What about defense stocks? What's your position at RIA with defense stocks? There's a lot of people that are saying, hey, that's where all the money's going, not just in the US, but kind of everywhere internationally. Um, that should play a bigger percentage in the portfolios going forward. What do you think?
No, yeah, we own, for instance, one of the stocks we own in our portfolio is Raytheon Technologies. We've owned that company when it was United Technologies, before Raytheon acquired them. We've owned that company for years, and we've made just a ton of money in that thing. Every time it goes up, we trim it back. It runs up again, we trim it back. The frustrating part has been we've been wanting to actually increase that exposure in the portfolio, but we can't get a good break where that thing will correct enough to allow us a good entry point. So, it's continuing to do well. I like defense companies. I think they're going to continue to do well. So yeah, you need, I wouldn't go massively overexposed in defense stocks. I think everything requires a balance. But yeah, you should definitely probably own some defense stocks in your portfolio.
Okay. All
But,
right.
real quick, with that said, all defense stocks are not the same. So make sure you choose wisely.
All right. So two questions on that. One, from a richness, sort of from a multiple standpoint, how is the sector currently trading? And then, okay, Lance, that sounds great. I want to own one of the good defensive stocks. What should I be looking for?
Well, price performance is one. I mean, that's kind of an easy way to look at them. If you start scanning through defense stocks, whether it's Northrop Grumman or General Dynamics, Raytheon Technologies, go right on down the list. You'll see some that have better stock market performance than others. So we kind of want to pick, don't buy the one that's beaten down when everything else is up, because there's probably a problem with that particular company. And yeah, there's sometimes stocks are cheap for a reason, is the point, right? So just make sure that you're buying the company that's in the right space, whether it's Lockheed Martin, whoever it is. So there's some great companies out there. But then again, at the end of the day, all these stocks are trading pretty rich. They're growing revenues like crazy. Fundamentally, they're very good. So, fundamentals will matter ultimately. But the one thing about defense stocks is, they can be volatile. So, if you're going to own them, understand that, it's not uncommon for defense stocks to trade down 10, 15, 20% and then rally right back to all-time highs. So you've got to if you're going to own them, you've got to give them more wiggle room in your portfolio and not, sell out at the first sign that they're going down.
Okay. Um, there was an announcement yesterday, day before, by Trump that uh, basically said he wants to increase the budget for the U.S. military, and I think it was by a good amount. He said he wants to get up to 1.5 trillion. Um, so presumably, I think Wall Street hears that and says, "Okay, should own defensive stocks." That's even more money coming their way.
Yeah,
Okay.
no. He said a couple of things. First of all, he said, he's going to ban buybacks and dividends until they get back to producing quicker, producing military equipment faster, and then also repairing equipment faster, which I thought was interesting.
Oh, okay.
Uh,
So that's a negative then for the stock price, right?
yeah, yeah. Well, it was negative for a day, and then the next day they went roaring right back to all-time highs because of the announcement. Hey, we want to increase spending. So, yeah, you got to take these things with a grain of salt. Look, I mean, at the end of the day, this president is very much pro-America, America first, increased national security, and that requires a stronger military. So, he's very pro-military, and that's good for the defense sector. And again, that's why we own exposure in that area. We'll probably increase exposure to that area at some point if we can get, like I said, get a decent correction in price. Um, but yeah, again, I think you just have to have exposure there.
Okay, yeah. And I got to say too, it's just crazy making. I mean, I spend a lot of time on X during the day, and Trump just throws these things out so fast and furious. And you know, like within the span of 24 hours, he delivered something I've been asking for years, right?
Yep.
Which was, hey, let's get big institutional money out of the single family home market. And I was like, God, thank God, I've been begging for that, right? And then
Yep.
less than 24 hours later, and then I want to buy 200 billion of mortgage-backed securities. I was like, come on, it's like the worst thing ever. Right? So,
I know.
it's
Got
bananas.
one step forward, one step back, right? So
Well, and look, and that's why, I mean, really, that's why I brought that up earlier. Like, I just sort of see that as increasingly like that tariff checks to households, whatever, like I'm going to do whatever it takes to try to win the midterms, right? So I would just say be prepared, folks, for lots of things, lots of unnatural acts between now and November.
yeah, and again, I see where his intentions are. I mean, and they're good intentions, right? It's like I'm gonna buy back $200 billion worth of mortgage-backed securities. We're gonna get rates down so people can afford to go buy a home. Well, the problem is
But
that
it's not. It's going to raise prices. It's going to keep that
exactly, but
affordability problem there. It's
exactly,
a gift to existing homeowners.
exactly. So the problem is that it's a well-intentioned, but this is most economic policy that comes
But I
out of
don't know if it is well intentioned. I think he's just like, I don't want to have a housing price correction before the midterms. That's going to be bad.
there's nothing on the horizon saying that a house price correction is even coming. There's nothing out there. Supply and
Oh,
demand.
God. Okay. I disagree on that, but let's not fight this time.
Okay, I'll tell you. Yeah, okay, fine. We can argue about it later. But the point is that ain't going to happen before the midterms. So, again, his goal is to be well intentioned. Hey, and look, to buy votes for midterm, get mortgage rates down, awesome, right? And that it sounds great. But the problem with the majority of economic policy that comes out of Washington is it's misguided. This sounds good on the surface, but they don't ever look at the unintended consequences. This is why we had the housing bubble to start with, was because of all the unintended consequences that came from adjustable rate mortgages and no money
Well,
down.
that's my, again, that's why I just hate it so much, which is you're not going
Yeah,
to solve an unaffordability problem caused by too much intervention by more intervention.
exactly. And yeah, and the same thing with checks to households. We know how that turns out. And I don't think he ever sends checks to households. I don't think he can get that pushed through Congress. But you know, that's a terrible idea. We know that if you send checks to households, you're going to create a spike in inflation. You're going to
Right
cause
there with you. Yep.
problems. You know, again, there's no incentive to do it, and it just makes people poorer at the end of the day because you raise the cost, they spend the money, and then they have no money, but the cost doesn't come down.
Yep.
So everything equalizes at a higher price. It's just bad. These are bad policies that we've been doing for over a decade. And you wonder, you look around, you go, why are we in the situation we're in? It all goes back to the financial crisis. Almost 90% of it is stuff we started doing back in the financial crisis.
Yeah, I mean, there are things before that I could add to the list, but I agree. It
Yeah,
it it
that's what I'm
it
saying.
it
That's
it, it,
10%,
it
90.
built a runaway momentum with the GFC. Yeah, and
Yeah,
everything
absolutely.
we should have done, we didn't, and we tripled down on the stuff that created the problems in the first place. Yeah.
Yep.
So, okay. So, anyways, enough about this. Except just I want to reiterate the folks, like, just prepare yourself. Who knows what the future is going to bring? As Lance said earlier, like Yogi Berra, predictions are hard, especially about the future. But a prediction I think that is easier to make right now is we're going to see more and more of these unnatural acts coming up to November. And like me, you might cheer some and hate the rest, but it's going to be deformative to try to influence the election results. All right. So this is kind of a little bit tied to defense stocks, but um, Lance, do you see any material impact that we should be aware of some of the fast-changing geopolitical developments that are out there? And I know in general, you think the markets don't really care because they've largely priced this stuff in. But very recently we had Maduro removed. Probably markets don't care so much about that specifically, but of course it has economic potential. Well, it has economic implications and certainly potentially around the oil industry in the future. We are, I think, in real time seeing a growing potential that the regime in Iran might be replaced. And I'm definitely rooting for that. I think if the people could throw off the yoke of that oppressive theocracy, that would be great for them and great for the world. Again, potential economic implications. Again, potentially big ones for oil. If all of a sudden Iran becomes friendly again and their oil stops getting sanctioned and all that stuff, hopefully at some point this year, there's peace negotiated in Ukraine. Again, potential material economic implications there if Russia starts doing business with the rest of the world again and Russia oil stops being sanctioned. Um, so you and I
All,
have
all,
been talking,
all this,
pardon me?
by the way, all this, by the way, is bad for oil, right?
Well, so I was going to say, you and I have been talking about how, hey, maybe this is the time to get into energy and oil because it's been depressed and all that stuff. But these are potential, big headwinds in front of it.
Yeah.
So
I mean, you're talking about potential big increase in supply of oil. So, but again, like Venezuela, it's going to take years.
it's going to take years to get their oil, yeah, production up.
So, and they're 0.8% of global oil production right now. So that's a non-mover. But your points about Iran and Russia are much more, near-term events. If those turned out that could bring more supply of oil to markets, depress oil prices, and bring inflation down. So everybody kind of root for that. But certainly not going to be good for energy stocks, at least near term.
So are you making any decisions right now, given all of this, or are you just in the watch and see mode?
Still watch and see. I mean, I'm still in the camp that I think we can see four in the 40s, right? Sub 50, mid 40s in oil. I don't think that's out of the question.
For a sustained period of time or like a blip down into it?
No, no, it'll be like a gradual decline, and then we'll kind of base and bottom for a while, and then start to, whatever is causing that, we'll get through that. OPEC will cut production, whatever it is, and we'll start to see oil prices climb back up. I just think you're going to see a better opportunity to buy energy stocks later than right now. Right now you're getting a bump out of energy stocks because of hype over Venezuela. I think that when people realize that's going to be years in the making, then I think that premium goes away and potentially you can buy the ExxonMobil Chevrons a bit cheaper here. Again, a lot of this depends on where oil prices go. And if some dynamic occurs in the next, month or 3 months or 6 months or whatever, that we start seeing an increase in demand for oil and a reduction in supply, which is what's going to drive the price of oil, then we'll start adding more. We have energy exposure now, but that's more tied to the AI data center development stuff. But we'll start adding, more of the kind of the majors in terms of oil and gas, kind of later on, opportunistically.
Okay. I'm just wondering too, like, let's say that this really does depress the price of oil for a couple of years at least, because, for all the reasons we just mentioned, more oil is coming on there. Does that take the wind out of the sails of the high flyers and like the nuclear space right now? Because it might take some of the urgency off the table a little bit. I mean, I know that oil isn't necessarily used for electrical production, but if it's just so damn cheap and plentiful, does it take some of the urgency of moving to some of these other energy sources off?
Yeah. Meta just cut a deal with Vistra and Oklo and one other company. I can't remember. Just caught me. I'm blank at the moment. There's another company. Anyway, Meta just did a pretty big deal with them to generate about 2 gigawatts worth of power from nuclear. But again, the problem with nuclear is it takes a long time to build plants, right? So Oklo is trying to build a plant. It's going to take them, several years to get that built. So that's why some of the energy plays we have now are focused on that behind the meter structure of providing natural gas or liquefied natural gas to data centers for power generation through generators. And that's why we like GE Vernova as an example, because they provide the generators. Um, I think that's the near term play. And then later we'll start to see, where power comes from and who's generating most of that power. But again, there's still the back end problem of this, which is the grid, which we don't have the ability to deliver. Great, you can build a plant, you still got to deliver the power.
Right.
And so one of the big factors is going to be the build out of the infrastructure to deliver the power on a consistent, sustainable basis.
Okay. All right. Well, look, in just that past 4 minutes or so, we have a lot of topics that will probably be interesting rants for us to have going forward, but not for today because we're on a time meter here. So I'm about to ask you about your trades, Lance. Before I do, and then we'll do the rant after that. Is there anything else that's like really burning brightly on your radar that I haven't thought to ask you about yet?
No, it's been boring. The good news is that the first 5 trading days of the year were positive. So as the old Wall Street axiom goes, so goes the first 5 days, so goes the month, so goes the year.
Okay.
So right now we've got one piece of the trifecta in place for
Okay.
a positive year. Now on the other side of
So the
that, we have
Wall Street groundhog didn't see a shadow, so we're feeling
exactly, but Santa Claus didn't come, right? So when Santa Claus
well,
fails,
but it's not like he brought coal either, right? I
no.
mean, the markets didn't correct or anything.
But when a failed Santa Claus rally occurs, you generally have more volatility in January and February. So you potentially have a corrective month in February, as an example.
Okay.
Which would, and again, like I said, after 8 months of just positive returns so far,
You'd expect.
a negative month would not be surprising at all. Again, that doesn't mean the market crashes, but a 2-3% down month in February, or 2 or 3%, 5% down by the end of this month would be out of the realm of possibility. So, you should be aware of that. But again, if we can, kind of keep our footing here, keep the markets where they are dynamically, everything looks pretty good right now. Earnings are okay, growth is okay. There's nothing looming out there at the moment that's a big impact, because again, all the narratives go set those off on a shelf somewhere because they don't matter. The only thing that matters is earnings. And what you're looking for is whatever event or catalyst it is that makes Wall Street go, yeah, we're not going to be able to generate those earnings this year. It's going to be less. And now I've got to reprice the market for lower earnings. That's the only thing you need to be watching out for. Everything
Right.
else is nonsense.
Yeah, but like I said, holiday online spending was at a record, so we're not seeing stress there yet.
No, exactly.
Yeah.
But you also got to
I mean,
take
we're
that
seeing a lot of stressed consumers, but it's not
yeah.
impacting the average spending yet. Yeah.
Also take that with a bit of grain of salt as well, because if you actually look at real retail sales, they've been flat now for like 3 years.
Hmm.
So retail sales, when we look at them on a nominal basis. And to understand why that's important is that if you fill up a gas,
If prices go up, even if you're buying the same amount of things, it looks like growth. Yeah,
yeah, exactly. So it's that's the real issue. Yeah, we're spending more to buy the same amount of stuff,
yeah.
and that's not really economically great
But
either.
but on that real basis, it's flatlined. But again, you're not seeing signs yet that it's
No,
deteriorating. Yeah, below the
no, not yet. But the important thing about that is historically is that when you go through a period of where real retail sales are flat, that's normally pre-recessionary.
Right.
So it's
Normally
just
pre-recessionary, and again, like I said earlier, like I look, trust me, Lance, you know me, I can come up with a whole bunch of concerns around this. But then again, if we give people the biggest tax returns in history, and then maybe potentially in addition to that, give them
yeah,
some tariff checks, that's going to lead to more spending, right?
yeah. I don't think we get the tariff checks, but
Okay. But
tax
maybe
cuts.
it's some other form of relief, right?
Uh, but even Scott Bessent said it'll be a function. The tariff checks will be a function of the tax refunds.
Yep.
So, but
But
again,
forget
I
about
mean,
the tariff check, just record
yeah,
tax refunds. So
$800
again, like I said, folks, you don't have to like this. You just have to be aware it's going on. Yeah.
$800 to $1,000 estimated refunds this year for most people. Yeah, that's that. They'll go out and buy new TVs.
Yeah. And the sad thing is, they'll take the money and say, "Oh, I've got this free money to spend," and then they'll spend more than that, right? Well, okay, I got $1,000, but the thing I'm going to buy is $1,500. So they're actually spending more money. They're out of pocket more than they otherwise would have been, right? If they hadn't gotten the check in the first place.
Oh,
But
real quick, one thing, and then we'll do our rant. There was a great article in the Wall Street Journal earlier this week. And you and I have talked about before all this speculation, zero data expiration options and
options, yeah.
leverage. Great article. There was a guy named Captain Condor, which he had this whole group of followers that were trading 0 day to expiration options. They
Condor,
were
because that's a formation with option
Yeah,
pair
yeah.
trades,
So
right?
he was
Yeah.
called Captain Condor, and he was using the old Wall Street method of betting, which is that if you lose money on your bet, you double the next bet. If you lose that bet, you double the next bet, so
Okay.
forth and so on. They lost 50. Basically, he wiped out their entire group. On I think it was on Christmas Eve, if I'm not mistaken. There was
Oh
a guy who
God.
actually went onto GoFundMe to ask for money to pay for bills for the month, but lost everything. And so the point is, and we've tried to explain this before, it seems like trading options are a risk-free bet, but when things go wrong, they go horribly wrong really quick. And this group lost like $50 million in total. So don't gamble in the stock
Yeah,
market.
yeah. Again, as we've said, the markets have gotten so used to speculating, sadly, because in
Yeah.
a lot of cases they've been rewarded for it for so long that
Yeah.
everybody is right.
Don't follow some idiot on a video that you're watching on YouTube. I mean, I wouldn't do it.
So it's funny. I mean, we've ranted about this a lot in the past, so I won't do it again here. But just how um, we have, with both carrot and stick, forced people to become speculators versus investors. Right? It's become cultural now. And I hope I'm not spoiling anything for you, Lance. But you watch Landman, right? Did
Yeah,
did you see did you
I'm
see the
not.
latest episode?
I'm not. So don't spoil it.
Well, okay. All I'll say is there's a scene where they go to in the last one where they go to a casino,
Uh,
and it is very
oh, I
much
saw the episode. Okay, I saw the episode where
okay. Yeah, and so what does she do? She does exactly that, right? Keep doubling down because she's losing, and then they have her win like $300,000 or something like that. And of course, the I'm watching that going like, what a terrible message to send to the American viewing audience that you just have to just keep doubling down when you speculate, right? Yeah,
yeah,
yeah, because you're going
but
to end up
that's
like Captain Condor.
exactly
All right, so trades. Have you made any trades over the past week, or as you said, are you still kind of in a wait and see?
the portfolio. Our main flagship portfolios are perfectly fine. We reduced, kind of rebalanced our all weather model a couple of weeks ago. The only thing we did this past week was really the new factor rotation model, which is now up and live and running. So that was started, January what is the date? January the 2nd. So that's the only thing that's occurred over the past week.
Okay, so if folks want to go check that out, they can go to simplevisor.com and find that factor model amongst all the other ones you have. Okay, so we're going to get you out of here fairly soon, Lance. I was reflecting on kind of a seminal person in my life, and I'm going to tell my story with them, but it's going to make some key points, some of which are ones that we've touched on in the past, Lance, but I think they're important to remind people of, especially at the beginning of a year. Um, so there was a guy who moved into my town when I was a teenager, or town next to me, and He was a longtime Broadway and Hollywood actor. He was a guy, his name was Max Showalter. He also went under the stage name Casey Adams. But he was a character actor, and he worked in just like he worked with everybody. I mean, there wasn't like a star of the silver screen that you could think of that Max didn't have a story with or wasn't a good friend of, right? Really charismatic guy. His most memorable stage role was as Horace Vandergelder in Hello Dolly, right? So he performed more than 3,000 times opposite Carol Channing and Betty Grable and Ethel Merman. He appeared in more than 1,000 television programs. Most folks watching this probably will know him from the film 16 Candles. He was Grandpa Fred in 16 Candles. I had this great gravelly laugh, but just such a great guy. And he ended up settling in the town next to me where I grew up. I grew up in a really small historic village in Connecticut because he had been filming some movie decades ago and kind of fell in love with the area and said, you know, when it's time for me to retire, I want to move there. So we did. And what he started to do to kind of just plug into the town and the community is he started showing, you know, these great movies. So I first met him when he was showing Singing in the Rain, right? So you go to this, you know, little theater. He shows Singing in the Rain. He comes out and he says, "Hey, everybody, you know, wasn't that great?" And we talk about it for a little bit. And he says, "Well, hey, look, do you want to talk to Debbie Reynolds, you know, star of the movie?" And she walks out from behind the screen because he's best buddies with her, right? And you get to just sit there and talk to Debbie Reynolds for the night, right? So he would do that again and again. Really just a wonderful guy, created a wonderful experience for the community. And he then started directing plays at the local playhouse, and that's kind of how I met him, really. I got to know him well. I got cast in a few of the plays, and so, you know, he directed me, and he really just became kind of a great mentor and really a great friend. So I used to just go to his house, and we'd sit down and talk for hours, and really just kind of the coolest guy. And, you know, what he would do is like, we're all like teenagers in these plays he's putting together. And then, you know, afterwards we'd go to his house and, you know, we'd talk to Mary Martin, right? Or we'd talk to Katharine Hepburn. It was just ridiculous. I mean, the access that this guy gave us. But anyways, the key story I want to tell here is one of the last times I went to visit him, we were sitting there in the table in his kitchen, and his house was just packed, Lance, with memorabilia, like just playbills and, you know, signed headshots of all the greats, but just things he had picked up in his travels around life. There were things there from the Palace of Versailles. It was just an amazing place to hang out. And his table was always piled with his writings or his uh, you know, letters people had sent him or things like that. And two things really notable about that trip. One, he gave me a book, and the book's called The Artist's Way, which it's a big best-selling book. I'm sure a lot of people watching this video know what it is. And turns out, I can't remember whether it was his niece or a good child of a good friend of his or whatever, but the author of the book, a woman named Julia Cameron, she ended up, you know, kind of falling on some tough times and needed a place to kind of land. And so she went and stayed with Max, and she wrote this book, The Artist's Way, while she was staying with Max. And then it became this massive bestseller. By the way, her name's Julia Cameron, Lance. Her husband is James Cameron, the director of Titanic and whatnot, right? So, you know, she went on to great things after this too. And again, Max was just the kind of guy that played that sort of pivotal role in people's lives. So anyways, we're sitting at his table and he pulls out this, this is back in the days where you had Kodak film that you would send to be developed. And he had a roll of, or, you know, pictures he had just gotten back from getting developed. And he was like, "Oh," he's like, "Adam, you're gonna see these photos." He's like, I found these cans of film from like, you know, the 50s or the 60s that I didn't realize I had. So I just went and got them developed. So he had starred in the movie Niagara alongside Marilyn Monroe. So I'm looking at these photos and I'm like, oh my God, Max, like these are candids of Marilyn Monroe. Like these things go for auction for a crap ton of money. And he's sitting on this stack of photos of just like hanging out with Marilyn. It was crazy. And then, of course, he started telling me stories of what it was like to film Niagara. And this is the key part that I want to share with folks. So Marilyn Monroe was at her height pretty much then, or zooming up to it. And the movie was made to be a vehicle for her. And they were staying near Niagara Falls as they filmed this. So there were these little bungalows. So he said that what would happen is they'd go to bed, and a little bit after midnight, Marilyn Monroe would creep into his bungalow and crawl into bed with him and just ask him to hold her while she cried. And he was like, you know, she was just a totally unhappy, totally broken person. And, you know, all she wanted was somebody to just give her a safe space to just, or a safe spot to land for the night and just comfort her and treat her like a human being. And, you know, him telling me about how she had absolutely everything that she had thought that she wanted, and the world thought that she was it. I mean, this was the height of Marilyn Monroe. Everybody wanted to be like her. And she was absolutely, completely miserable. Just heartbreaking here. So, you know, the message here is a lot of the things that we aspire to culturally, they aren't the brass ring that we think they are. And, you know, a lot of the people that are, you know, we think are the most successful conventionally sometimes are the most unhappy people. And I mentioned in the past that my wife is a couples therapist, and she has a lot of clientele, especially from Silicon Valley, who are extremely wealthy. And in almost, I mean, not in every case, but in a lot of cases, you can point a direct inverse relationship between the amount of money somebody has and the amount of dysfunction they have in their relationships in life. And so the key thing that I just want to sort of mention about this story is yes, this is a wealth channel. Yes, we focus on money and all that type of stuff. But the things that really matter in life, the things that are going to bring you happiness, if that's really your end goal, is to have a happy, fulfilled life, it's not the material trappings. It's not the fortune. It's not the fame. It's the things that Max truly understood, because this is what he focused on, you know, when he moved into my area. It was about community. It was about being in service to others and having a sense of purpose, creating good friends, appreciating nature. He had a little house. It was surrounded by a little apple orchard. He always had I think an English terrier, I'm sorry, English bulldog with him. You know, these dogs with the big bulging eyes and the snuffling snouts and stuff like that. But it just brought him so much happiness, right? These simple pleasures. So anyways, I learned a lot from Max, especially about the type of man that I wanted to be and who I wanted to grow into. He was very influential in shaping that. And, you know, I just really miss him. But anyways, I'll pause here, Lance, because I'm sure you've got stuff to comment on that, but I'd love to hear too, if you had anyone in your life that kind of played a similar role.
Yeah, I mean, you know, look, we've talked about this before, is that, you know, money doesn't buy happiness. It does buy whatever comes in second. But, you know, we
It,
focus a
it helps
lot.
you rent it, as Weird Al Yankovic would say.
What I mean by that is and you know, what's important is there's two reasons why people are unhappy, right? So primary reasons. One is, you know, they have some dysfunction in their life, whether it's their relationship or whatever it is, jobs, whatever. So they're unhappy about that. But if you're also struggling financially, it just compounds the issue of unhappiness, right? So what I mean by money buys whatever comes in second, it removes that, you know, having money removes that obstacle of just trying to struggle to make ends meet, which is, you know, as we talked about before, two leading causes of divorce are infidelity and finances. And if you've got trouble with finances, it's probably going to lead to infidelity at some point, right? Because you're just trying to find an outlet to be happy or to find
Right.
happiness. And, you know, my life sucks over here, so I'm going to go try this grass over here, which looks to be greener. It isn't, but you know, that's just human nature. Um, you know, so, you know, we spend a lot of time on this channel talking about doing the right thing with money, building wealth, you know, taking advantage of markets, those type of things, because it does help provide that underpinning. So underpinning that you've got the ability to focus on what the other problem is that's keeping you unhappy, whether it's relationships or jobs or whatever the fact is. But one of the lessons that took me a long time to learn was is I was always out chasing money. Like ever since I was out of high school, I was running my own businesses. When I was in college, I was doing working in banks, working in finance. I was trying to figure out you know where the money's to be made. And I've always just been that person. This is why I've just been a serial entrepreneur over life, which is starting businesses, growing them, selling them, moving on to the next thing, kind of always chasing that goal. And you know, it just took a long time for me to realize that that wasn't making me happy, and that I had to focus on other things to find what it was that I was missing, which turned out to be family at that point. And it's just when I was younger, I was like, I never wanted kids, I never wanted relationships. It was all about chasing the dollar, and
Hey,
that was
sorry,
not making
personal question for you to wrap into your answer. If you want to answer it, you can tell me it's none of my business.
none of your
Um,
business.
but your current marriage is your second marriage,
That's correct.
and were some of these lessons you were learning about the balance of money and other things, were those learned through that first marriage?
No, but unfortunately, my first marriage was a function of just a bad partner choice.
Okay.
And there was, you know, it had nothing to do with, well, I shouldn't say that. That's not
I didn't
true.
want to derail us. I was just wondering if it was
No,
relevant
no,
to the
no,
point
no,
you were
no.
making.
There is actually a point to that, which is, you know, and so my work day, as an example, used to be, and my current wife will tell you this as well because she was part of this work schedule, but my work schedule started at 4 in the morning and ended at 11 at night.
Hmm.
And so, my first marriage failed partly, there was a big chunk that was her responsibility, but I have to take responsibility for that as well, is that I was out chasing the dollar, and she didn't understand that while I was doing that, it was affording her the lifestyle that she wanted, but she also wanted me to be there all the time.
Hmm.
And I couldn't do both, right? And so at the same time that she wanted this lifestyle that she wanted to have, which I was having to work to provide, and it required me to be away from the house to work to do that, but that was the conflict, right?
Yep.
The reason my second marriage has worked so well is, and then when we got together, I told her up front, I said, look, this is what I'm doing, this is my goal, and these are the hours that I have to work to do this. And there were reasons my hours were set. I was running a business during the day, doing radio from 4 o'clock to 8 o'clock at night, then doing a national radio show from 10 to 11. That's why I didn't get home till 11. And so I explained this to her, and she's like, okay, I understand. My job, this is why I'm talking about, having a really good partner. If to find happiness, you've got to have a really good partner in life. She says, look, my job is to take care of the house, take care of the kids. So while you're out doing what you have to do, you don't have to worry about what's going on at the house. Then when we come together, you have to commit that when you come home, it's all about me. And I
Hmm.
was like, deal, done. I can do that. And that's why our relationship has worked very well for the last 15 years, is that we have maintained that relationship. She works a full-time job. I work a full-time job. When we meet, though, at the end of the day, work turns off and we just focus on each other, what we're going to do, etc. And that's what makes that relationship work. But that's also where I ultimately found happiness, was finding the right partner that allowed me to be who I was, but then also taught me the benefits of having a strong foundational family structure. And that's where, with the kids and the relationships that I built with my children, the relationships I built with my wife, that's where I found, the happiness for me, right? For me, that's happiness, right? That family unit structure gives me joy, and I enjoy taking them to go do things and enjoying the fruits of labor. But that's why I work so hard, is to provide for them and to do the things that I can for them.
All right. Well, one, thank you for being so transparent, Lance. I know you didn't know I was going to ask you that personal a question that personal. I'm very happy that you have found yourself to that stage. You're a good guy. You deserve it, and so does your wife and your
Well, it
family.
only took me 47 years to get there, but
But you got there. It's the important part. And you're helping me make my sort of concluding points here, which is, uh, you know, so yes, folks, we talk a lot about money and pursuing the brass ring and what life, but as Max's story about Marilyn tells us, It's not the trappings that matter, right? It's the other things that are much more fulfilling and real. And so my counsel to you all is to really spend some time reflecting on what truly matters to you in your life and really focus on that stuff, right? I mean, spend your time really leaning into that stuff. If you've got someone who changed or influenced the trajectory of your life, like a Max, like Max did for me, if they're still alive, reach out to them and thank them. I mean, there's not a week that doesn't go by that something reminds me of Max, and I just wish that I could tell him now that I'm a full adult, the impact that he had on me. There's a ton of conversations I would love to have with him now that I'm, older and can see life through eyes more similar to his. And I'm just so sad that I can't, right? So if you've got someone like that who's still alive, man, reflect back to them at the impact that they've had on you. And then third, ask yourself, most of the viewers here that are watching are 45 and older, and I just know that from all the surveys that we've done. So we're a bit older. So a great question to ask yourself is, well, who can I inspire? Who could you be a Max to in your life? That's a part of I think the privilege that we have at our point, if we've gotten to this age and we've learned some of these life lessons, particularly if we've amassed some sort of success and understand kind of some of the fundamentals of what creates a successful life, how can we pass that along to the next generation, especially as we've talked about a lot in the past, a younger generation that is having a tough time finding their way into the future. So, highly encourage you to think about whose life trajectory you might be able to positively change going forward. And with that said, if you think one of the best ways to improve your life trajectory is to continue to watch Lance Roberts on his channel week in and week out, let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. I tell you, Lance, I tie you to that call to action as best I can every week. If you would like to get some help from a professional financial advisor in terms of positioning your financial wealth for the year ahead, one that might be as full of twists and turns as Lance and I think it might be this year. If you don't already have a good professional financial advisor playing that role for you, well, then consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to even talk to Lance himself and his team there at RAA. To do that, just fill out the very short form at thoughtfulmoney.com and the advisors will be in touch with you right away. As a reminder, Andy Scheckman's offer while supplies last to be able to buy junk silver from Miles Franklin for just $1.35 above spot. Supplies are still lasting so far in that. So if you want to take advantage of that, just go to thoughtfulmoney.com/buygold. And again, if you want to join Lance and I in Houston next week, go to realinvestmentadvice.com, click the link at the top of the page, buy your ticket and come join us. Lance, as usual, my friend, I'll give you the last word.
No, I really would like to see you in Houston. So like Adam said, come to the conference. It'll be a lot of fun. We've got a few tickets left, so go ahead and do that sooner rather than later because they are going to go pretty quick. And Adam, looking forward to seeing you next week. Should be a lot of fun.
Yeah, and Lance, I think if you don't mind, we got to record our session on Thursday next week before I hop on the plane, so that folks that aren't at the conference have something to watch while we're there.
No, I was going to ask you when you wanted to do it, but yeah, Thursday's fine. I can make that work.
Okay, fantastic. All right. I'll send you a calendar invite after we hop off here, Lance. See you in a week, buddy, and everybody else. Thanks so much for watching.
Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time. But I think a reasonable target of 4,000, I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, oh, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple-digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar, a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise, just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prechter Jr., with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular, and then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing the tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very very viable market for the long term? Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second-class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. My January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver, and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aim the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from in 10 or 20 years. And saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, So I never expect them to be write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and you blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low end earnings estimates, so they can always say they beat them. These generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half of 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, a gentleman made a good point to me the other day, and it was Sam Lee, it's actually the largest stock that I own, North Isle Copper and Gold. And he was just on a trade mission for Canada to South Korea and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy, because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
We've not only taken out the big problem that we had with silver at 3,300, there was such strong technical resistance. There was also technical resistance at about 35, but it just sailed through there. And we'll go back to a daily chart so we can get a better idea of what we're looking at. $40 is our next anticipated level. We could encounter resistance. I'm not really expecting any real resistance there. Our studies right now are looking for $42 on the upside, and it is based upon not a daily, but rather a monthly. And so that's the thing. You can, as I said, we've got to go way far back, really compress this chart before we see the last time. Silver seems to have locked on it, but the last time was 2014.
Silver has broken above the long-standing $35 resistance, reaching levels not seen in over a decade due to tight supply and strong industrial demand from sectors like solar and electrification. Prices have climbed near $39 to $40, with analysts targeting $42 next and the potential for $45 by 2026. Institutional forecasts by Bank of America, Citigroup, Saxo Bank, and others also converge on a silver price around $40 by late 2025 or early 2026. Gary Wagner, a seasoned technical analyst and the host of the Gold Forecast, explains that silver has recently surged past significant resistance levels, reaching its highest point in over 13 years. This upward momentum is attributed to a combination of factors, including strong industrial demand, particularly in renewable energy sectors like solar and electric vehicles, and a persistent supply deficit. As of August 30, 2025, silver is trading near $37.95 per ounce. Silver has been trailing gold but is now starting to catch up with impressive momentum. However, gold has built strong momentum, rising from 2,300 in March 2024 to over 3,500 before consolidating into a symmetrical triangle. This pattern often leads to breakouts in the prevailing trend, which remains bullish. After pulling back to the lower channel, traders went long near 3,410. A close above 3,473 would confirm the breakout, opening the door for a new leg higher. Despite recent gains, the setup points to more upside ahead. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Lagging behind gold, obviously. Yeah. This, of course, is a daily, and what I was looking at, and I'll flash it back, was a monthly. So you can see the performance this month from 37.48 up to 39.72, quite a move, 2.42%, $2.42, up 6.5% over the month. And the thing is that this red line was drawn in yesterday because that's where silver had closed yesterday. And so we have not seen these prices really since February 2013. It's definitely the bullseye target right now. Could it go higher? Yes. Yeah. It is reacting in a much more sensitive manner to follow gold, which it was not. And now we're seeing it play catch up, so to speak. So I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there. 42.30, and that's the first target. If it breaks strongly through there, 44 would be the next upside target above that. A daily Japanese candlestick chart, and of course I'm using a combination of studies, but basically trend analysis, Elliott wave, and pattern recognition, such as this symmetrical triangle that we're witnessing. And what we notice is we've had a runaway bull market. If we move it back a little bit, you can see that, as you know, we're sitting at 2,300 in March of 2024. Not too much to move it to 3,200, 3,400. So we've got 1,000, and then it runs up to the all-time record intraday high, well above 3,500. Viewers, I am looking at a futures chart, so the numbers will be a little bit different than spot. Yeah. And then we knew, at least our model predicted, we were headed for a correction, and that's what I thought we would see. But Typically in a correction, you get something like an A, a B, and then a C, and then you go back to the motive phase, a 5 count of bullish waves 1, 3, and 5. In between, you get corrective waves 2 and 4. But what happened was when we saw the market go up and hit this top, we had already drawn in the compression triangle and come down. We realized that this was not unfolding as a simple ABC, but something a little bit more complex. This is simply called a symmetrical triangle. The idea behind the symmetrical triangle, of course, is you're going to have a series of rallies followed by a series of shallow corrections, shallow rallies, until you typically get to the E wave. Following the E wave, as the model predicts, and not so well this time, you get what's called a thrust. A thrust is simply when prices break above, that's the wrong one, but is simply when prices break above the resistance line and you get that hardcore breakout. We certainly didn't see that. And so we watched gold go back into the channel. Let me just kind of blow this up a little bit. Go back into the channel and trade back down to the lower end of the channel. At this point, we realized since it did not occur here, meaning a thrust or a breakout, this would be, if it's going to do it at all, this would be the time. This is when we got our subscribers long at about 34.10. We had enough confidence that it's probably not going to break to the downside because, Jeremy, a symmetrical triangle doesn't necessitate a breakout to the upside or the downside. Either can happen. Typically, we see it go to the prevalent trend direction, which of course is higher, and that's exactly what we saw. Now, today, we're right at the resistance line. I hope our viewers can see it. I'll blow it up a little bit more, but as you can see, we've just gone over that a little bit. And so this was the breakout that I have been waiting for. And I believe that a solid close above, let's call it 34.73, will signal that we are going to see a strong breakout to the upside, moving gold substantially higher, even though it's already traveled from 33.58 to 34.78. So it's gone a significant amount, but we think that there's a lot more room to the upside right now. As long as we get an effective close above this resistance line, which it clearly looks as though that's a highly probable outcome.
Gary highlights that the US dollar index is exhibiting a notably bearish technical outlook, influenced by its performance relative to key moving averages. Recently, the dollar has fallen below both the 50-day and 200-day moving averages, signaling a weakening trend. The 50-day moving average, currently around 98.1, is acting as immediate support, while the 200-day moving average, positioned at approximately 102.7, remains well above current prices. Additionally, the 50-day moving average has crossed below the 200-day moving average, forming a death cross, a classic bearish signal in technical analysis. Gary thinks that this alignment suggests a shift toward more bearish market sentiment. Furthermore, the relative strength index is hovering near neutral levels, around 50, indicating a lack of strong momentum in either direction. Covering all the scenarios, we can say that the US dollar is currently facing significant technical headwinds, with both short-term and long-term moving averages indicating a bearish trend. Traders and investors should remain cautious, monitoring for potential further declines if the dollar fails to reclaim key support levels.
This is our simple 50-day moving average, and that's what we would look at for short-term market expectations. If it's above the 50-day on a short-term basis, we are in a solid bullish demeanor. The 100-day is intermediate, and then the long-term is the 200-day. And so I've highlighted the 200-day is in red. Green is the 50-day. It melted through the 50-day, came down and melted. You see how exaggerated the moves were on the days when it broke through the 50 as well as the 200. And so that's significant because what that tells us is that on a technical basis, on a very long-term basis, the dollar is extremely bearish and has more room to the downside. In terms of targets, if it continues to drop 95, I'm basing that on a Fibonacci retracement data set that beginning of May at 89, up to the record top that we've seen recently at 114. And then the important numbers are drawn in. This is the 78% retracement. This, of course, is our starting point. As you can see, this is the 38. This is the 50. And the fact of the matter is, we're probably close to the, we've even broken through the 61. And in terms of corrections, 61 is a very deep correction, but acceptable. 78 is acceptable, but actually fairly rare. And a break below 78 would mean that we're not looking at a simple correction, but a flip from a corrective expression in a bullish market to a fully bearish market. If we broke below 78, that would signal that. You notice also when you look at this chart, the 61.8, it comes down, it tests this area, it pops back up, and look, it finds resistance at the 50%. Then it comes back down, breaks through it, and you can see all of the attempts that came in. Let's go ahead and widen this. All the attempts that came in to break back above that, and all of them were unsuccessful. And because of that, that tells me the dollar absolutely has a higher probability of going down than going up.
Yeah.
And the next target, as I said, would be about 95 on the dollar index.
Silver is showing strong bullish momentum, breaking key resistance levels and catching up with gold, while gold itself remains in a bullish breakout setup. Conversely, the US dollar is under technical pressure, with long-term and short-term indicators pointing toward further weakness. These dynamics suggest a favorable environment for precious metals, though investors should remain vigilant to potential market corrections and shifts in momentum. How might the dollar's ongoing weakness impact silver and gold prices in the coming months? What are the key levels investors should watch for to confirm continued bullish momentum in silver and gold? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation, statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are monetarily speaking. What is happening in the monetary system? It's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government or the Fed under him or beside him or whatever the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or Us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say like I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop out, but it's also true. And gold is still money. I mean, it doesn't really matter because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on U.S. Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now, let's review the interview.
No, it's not going to replace anything. We're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But like, I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it, and then it just falls over anyway. That's the analogy that just came to my head. Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis? Or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey,